Let's look at a health and wellness ETF. So first off, read this disclaimer carefully and do your good deed of the day by liking and subscribing. So, we can find health and wellness here under consumer cyclicals. So here it is. We have a 55-ish% gain here from the low. Pretty close here to the 52-week highs. So we are certainly outperforming here the total world stock market ETF. So the name of this ETF, BFIT is the ticker, Global X Health and Wellness ETF is the name. So these are weekly data points, all the data we have here. So this is part of a very strong trend that I am certainly bullish on long term. But it's always important to sort of look at, okay, what is more or less likely future price development, what is a good risk reward, so on and so forth. And the current RSI, weekly RSI, it's high risk for bulls, for new bullish positions, and also those who are still long should certainly have some tighter stops, because here we have a similar RSI and we go below the pinkish 10-week moving average. Here we go down to test the 5-week from a high. Here of course we have a pretty epic crash. Here we test the green 50-week moving average. Here we eventually go down to test the blue 100-week moving average. And the PPO is also at a very, very high level. But we don't have readings for PPO beforehand, because you need 200 data points to calculate the 200-week moving average. But yeah, we have a very high reading. We have seen some nice uptick here in volume. So there definitely is interest in this entire space, which I am to be perfectly clear, I am definitely bullish on it long term. It's just that when is it a good time to enter BFIT, and when is it a good time to maybe take some chips off the table. So on the daily RSI we have a similar situation. It is rare for us to get a higher RSI. We usually tend to have some pullbacks. One of the relatively frequent pullback levels is the purple 20-week moving average, 20-day. Okay, purple 20-day, because these are daily data points. 20-day moving average, and we also dabble a bit around here the blue 100-day moving average. It was pretty key back here. After that plunge, we haven't gone down there fully to test it, but because it was so relevant in the past, we see this situation where the bulls, they start to buy before we get down there, but that frankly validates that moving average. But yeah, we are at a very high level, accumulation distribution. Ever since, this high, we see that it has been flattening out a bit. So yeah, it could go higher, of course, but this is an elevated level where we do see that there's a tendency for some bearish action, though so far it's been very modest. We have not seen anything, spectacular. Some of the recent bearish, short trades, like this one as an example, this was, just minus 4-ish%. If you take this one, approaching 4%, which is not much. But the benefit is that if you do have a portfolio with both bullish and bearish positions, if we do get, a more significant pullback in the market, and, there is, 95% positive correlation here with the S&P 500, then you will be way better positioned. It is much easier to enter bearish trades before a pullback really begins than it is during the pullback, because if you take like this plunge here during the lockdown, it was a lot of people were just who didn't have, bearish trades. They were just stuck, they were just waiting for an opportunity, and then they think that, oh, here the correction is over, and then it goes lower. So it becomes very difficult. The seasonality for BFIT is interesting because we do have a few years. We kind of only have 5 years here, but it is sufficient for us to be able to draw some conclusions. So June and July are strong. Hence, it could be that BFIT will be able to goof around a bit here in July as well. But August and September, October, these are very weak. Hence, there is a weak period around the corner. So that is definitively something to have your eye on as far as the more bearish trades go. When we look here at Finviz, they draw trend lines as they like to do. And we are approaching, we can't fully see it here, but we are certainly moving towards the upper end of the trend line, which has triggered some pullbacks in the past. So when we compare the BFIT with the XLI, the consumer discretionary spider ETF, go here to performance. So year to date, you can see that BFIT is outperforming. When we look here at beta, BFIT actually has somewhat lower beta here than XLI. Price earnings is also lower, though both are elevated. So yes, sure, BFIT has a lower price earnings than the XLI, but yeah, historically very high levels. Looking at the dividend is approaching double for XLI. The problem with that for BFIT is that you are not going to hold this ETF for the dividend, which means that the hands that are holding BFIT, they could potentially be significantly weaker than those who are holding the XLI. Even though the XLI, the dividend here is not, impressive, at least the dividend is somewhat hedging a downside, though not in any significant degree, to be clear. So when we look here at the holdings for BFIT, so you got a bunch of sports and athletics companies, Dexcom going here into the medical space as well. Peloton, that's received a lot of attention. So we have a bunch of very interesting names, big brands in this space, and this is definitively one of those trends where I think there's a lot of future growth potential. Here's the market cap breakdown. Some nice mix here. Also, it is regionally diversified. So if I were to sum up my take here for BFIT, so this is a powerful trend. This is a mega trend. So long term, I'm certainly bullish. But one of the issues with mega trend is that the market is forward looking, so there's a lot of people who want to rush in, and frequently we do see that participants get a bit too eager, and that can create the preconditions for a correction. So yeah, I think that at this point it's not. The data is pretty clear that this is not ideal this is not like a value. This is not like a value opportunity to go, full bore bullish. This is a time to consider more speculative, bearish trades, which is, very fortuitous in the sense that you will be then more market neutral. Sure, given that we have seen, bubble tendencies in the indexes like the S&P 500, and other, stock market indexes, it's been frustrating to be entering bearish trades. There's a lot of turnover. But the thing is that it's during the bubbles as well that's when it's most important to be more market neutral, because when bubbles do unravel, it is very dramatic, and it can be an absolute nightmare to enter bearish trades during a sharp sell-off. Like here, very few expected it to go this far down. Just very few did. Because there was, talk about contagion back here, but this is when it really developed. But you do see the market was, significantly overbought beforehand. So if you just had a market neutral strategy where you turn bearish those who are, more overextended to the upside, and more bullish those who have recently had a pullback, then even way before this happened, you could actually be prepared just by using that, logic.